Now, without further ado, I'd like to hand it off to the star of our show, David Doolin.
Thank you and welcome everybody. Looks like we've got a super manageable crowd. So if we have questions at the end, I appreciate. We should be able to get to all of them. Very difficult for me to multitask, and so just to let you know, if you do throw things in the chat, Lynn will be looking at a little bit maybe, but mostly I'll be checking it when at the end of the presentation. Today's presentation has kind of a unique name, but really what we're going to do is we're going to have two premises. One is that you're coming to my office, you're starting a business, and you want to chat with me about what you should do. And I'm a tax guy, so we're going to talk pretty much from a tax perspective, but I'll give you a few hints too about just operating. And sort of bring up things that have come across over the years that have made it easier for my clients down the road. The second assumption we're going to have is that you plan on being really successful, because if you don't plan on being really successful, a lot of this doesn't really matter. The assumptions are, when you come to my office, is that you're starting a successful business, and how am I going to help you navigate through that success in the most efficient and ultimate outcome way to you. So now I'm going to share my screen and we'll get started. So I think you should have the slideshow now. And there's a lot on there on this appropriate entity structure and tax benefits for startups. Again, this is just our conversation. So here's what we're going to talk about today. First is sort of the formation of the company. The second is operation and record keeping. We're going to talk a little bit about the R&D credit and how it can really benefit startups. And then we're going to spend some time talking about the tax benefits to owners when you ultimately sell the company and you have tremendous success. So on the formation, the first thing that we talk about is, okay, you come into me and we're starting a company, and the first question is, well, when do you come to me? Well, you come to me a little bit after the idea, and as soon as possible before you certainly, when you get outside investors or start hiring employees, then you need to start considering, okay, well, it's not just me anymore. It's not just my idea anymore. Now it's time for me to really consider, what should I do in terms of getting the appropriate entity and how do I go about it? I'm going to tell you, do not go to LegalZoom and set up an entity. I know it's the most inexpensive way to do it, but you're definitely going to want a team around you all the way along, and having an attorney and accountant from the very beginning is extremely important. And I'm going to tell you why in a bit. So the appropriate entity, there's a partnership, there's a corporation, and a corporation can be taxed in two ways. One as a corporation on its own, or one as an S corporation, which is a little unique. And all these are available things to you. They may be things that you've talked to people about before. I'm going to tell you, if you're starting a business now, and it's a business that is in sort of the tech space, it's looking at you getting outside investment. It's not just you starting your own business. You're going to have employees, and employees that are used to getting some form of ownership down the road in exchange for working hard and maybe getting paid a little bit less than they would be in the open market. Then you're going to want to form a corporation and have it taxed as a regular C corporation. The reasons are that, number one, it's a very familiar entity to venture capitalists. That's the entity that they're used to dealing with. Outside investors sometimes can choose other entities, but frankly, most companies that are going to get some sort of venture backing or outside investors are going to want to be a C corporation. In addition, your employees are used to getting stock options, incentive stock options, or non-qualified stock options. They're much easier to do and much more familiar with a C corporation. And the third thing, which is something we're going to talk about a little bit more later, and something that will probably benefit you most greatly, is as a C corporation, and as a C corporation as early as you possibly can be, you could have significant tax benefits for you and the other investors down the road when you have a transaction to sell the company, and that is probably the most valuable reason to choose a C corporation from the very start. There's a lot of questions that people have about, where do I incorporate? Do I want to do it in California? I'm probably familiar with a Delaware corporation. Delaware is a very comfortable state for corporations because the laws are such that they're corporate favorable. You can choose any state you like, and that's sort of an issue that you'll have with your attorney. Delaware is very common, but in the end, you're going to be, if you're in California, if your offices are in California, if you're doing business out of California, you're going to need to register in the state of California. You can't avoid California tax by incorporating in a different state if you're actually physically located here. The next thing that we're going to talk about is sort of importance of records. Okay, so we got you incorporated. You went down to the bank with your incorporation papers. You opened up a bank account. Once you open up a bank account, you basically got the start of books and records. From a financial perspective, it's very important that you invest in just maintaining decent books and records from the start. And there's a lot of reasons for that, and some of which become more apparent as we get going here. But setting it up on QuickBooks, hiring a bookkeeper, arranging things with an accountant are very important. And it's very important from the start, because the sooner you do that, the more money it'll save you down the road. And again, we're assuming success, and the more successful you are, the more important it will have been that you establish good financial records from the start. That starts with setting up your accounting records on some, first of all, opening a bank account. Once you have a bank account, then setting up accounting records in something like QuickBooks. The third thing that's sort of different in today's world than it has been in the past is identifying how many states you're actually in. For a startup, that may be it's just where your employees are. Once you start selling, then it becomes a much bigger issue. But prior to selling anything, really just identifying where your employees are, paying them in the right state, and setting up to do business in the right state. And that'll save you a lot of headaches, because what happens is as soon as you start paying people in a state outside of California, then what happens is the state identifies you as paying them there. And also, as soon as they do that, then they're going to want a corporate tax return from you. So it's better to just get out in front of it, identify it, make sure that that you're paying them all correctly in the right state, that you're registered to do business in that state, and then stay up to date on your compliance in that state. The next thing is, okay, well, you've issued stock to yourselves, your founders, and how do you keep track of that? Initially, you can do it on an Excel spreadsheet or something like that. As soon as you get to the point where you start issuing stock options, you set up an incentive stock option plan, it's incredibly important to maintain your cap table. In fact, the thing that doesn't flow through your financial records necessarily, but is most important to keep track of, is who owns your stock, what form of stock they own, and who have been issued or promised options to purchase stock down the road. All those things happen pretty quickly, usually after either you got some early funding, or if you have some sort of outside funding, then that's when these things happen. The challenge is the best time for your employee to get a stock option is when the company is the cheapest. At the time that the company is the cheapest is when you are initially forming or soon thereafter. So the setting up a plan and getting that in place early, and then tracking who's got those options early, sometimes even before you get an early round of, you're sort of in the friends and family stage where you're just getting early startup funding, or angel investing, even before angel investing, all that happens. Once you get some sort of an angel investment, or you get it down the road enough so that you create some value, then there's going to be some pricing issues. And once that comes in place, that's when you need to start thinking about what's called a 409A valuation. A 409A valuation is a valuation that's performed for the specific purpose of issuing compensatory options to your employees. And that becomes a very big deal when you start issuing options and when you start getting money from outside investors. And the reason for that is that if you were to issue an option for less than the fair market value, let's say your company was founded and you all put in $10,000 or even $5,000 and issued 50% of the stock, and so your shares are worth a penny each. And then 2 years later, you bring in an outside investor, and he decides to revalue the company at $1 a share. Well, if you issued employees in that 2-year period options at the penny per share, and in fact didn't do a 409A valuation within enough time of the issuance of those options, and suddenly the IRS comes in 10 years later and says those shares are worth $1 a share, that can lead to significant financial problems for both the employee and for the company, because the company will have not appropriately calculated payroll taxes and things like that on the shares. So the bottom line is, as soon as you get to the point of issuing options, and you want to do that as soon as you possibly can, then you're going to want to get a 409A valuation, get it done, invest the money, and start doing it annually from there on. That's sort of the basics of record keeping. There's a lot more detail that happens when you get going, but that sort of can get your mind working on what you need to do. The next thing I want to talk about is one of the real big benefits of related to payroll taxes, and that's using the R&D credit. A lot of people come to me and they say, well, why would I care about the R&D credit? I'm losing money, I've got losses, I file a corporate tax return, and when I file the corporate tax return in the startup period of time, I've got these losses that are being accumulated. Why would I invest the money to have you do an R&D credit calculation for me? And the answer is that the IRS the Treasury and the IRS starting in 2016 changed the law such that you can use up to $250,000 per year of R&D credit to reduce payroll taxes that you're required to pay for your employees. It's a big deal. I mean, that's like money directly in your pocket. So there are a number of rules around it. You need to have had a period of time in which you did not have any income, and that you can keep that going for up to 5 years if your revenues are less than $5 million. So again, what you're going to want to think is, I'm a startup. I just started hiring employees. I just got some angel funding, and we're developing a new product. If that's the case, then the light bulb should go off. When I do my corporate tax return at the end of this year, I'm going to want to have the R&D credit calculated. And when I do that, the following year, so it's the year after the year in which you create the R&D credit, you give it to your payroll company, and the payroll company uses that amount as a reduction of your payroll taxes, federal payroll taxes going forward. That's a big thing. And again, getting back to keeping records, quality record keeping is very valuable in determining the amount of the R&D credit. So there's a direct correlation between decent record keeping and actually getting cash in your pocket. So the next thing I wanted to talk about, and this is the biggest benefit to owners, and this is, okay, I've been operating my company for a while now, and I'm thinking about making a transition. Hold on, let me just make sure. Yeah. And I'm thinking about selling the company. I got some venture investment. I've built this company now to a point where a lot of outside investors are looking at me. Maybe I got $20-30 million of funding. Maybe it's worth, 50, 60, $100 million, who knows, a lot. I now am an owner of a company with a big opportunity to sell. This is where, getting back to the beginning, the benefits of having incorporated as a C corporation from the very early days will benefit you individually as the owner. So that is what's called Section 1202, qualified small business stock. To take advantage of this benefit, you must be a qualified small business. So qualified small business is a domestic, well, you incorporate in the United States, C corporation for all the time from the issuance of the shares to you and the date you sell the company or sell your interest in the company. At all times from 1993, obviously, if you're just starting this company now, that doesn't apply, but from the date of the formation of the company to the date of the issuance, you need to have assets of $50 million. So what that means is, if I have a company that in year one issued me shares, founder shares for a very small amount of money, those shares will qualify as qualified small business stock. In year 5, if I get $50 million of funding, then any shares that are issued to me after that $50 million worth of funding assuming that money is in the bank for one day, that will not qualify anymore. So it's really the stock that's issued early on before you get $50 million of usually in funding, or you have sales such that you've accumulated assets that exceed $50 million. And immediately after the issuance, that's part of this. Immediately after the issuance, you have to meet that $50 million milestone. So if you got $25 million of funding a year ago, you still have most of the cash in the bank, and then you get $40 million of funding now, anytime after you get that funding. So if you got your shares in conjunction with that $40 million funding, or the whatever kicks you over the cumulative $50 million, that won't qualify anymore. Again, this is early shares. Okay. Very, very important that the stock is acquired directly from the issuing corporation. Okay. What that means is you can't, if your friend is a founder of a company and you buy some shares from him, those shares do not qualify as small business stock, even though the shares would qualify that way to him. If you're buying it in a second party transaction, it's not going to qualify. They must be acquired for cash or other property. You can trade your car for shares if you want, or for services. Okay, so options do qualify as qualified small business stock, not the option itself, but the underlying stock. So you're going to see in the next slide that there's a holding period on this, and to qualify for the appropriate holding period, you need to exercise your stock early on, because you need to exercise your options early on so that you're holding it long enough as stock, not as an option. And that's crucial. I'm going to talk a little bit about option exercises in a minute, but just remember, for you to qualify for Section 1202 and qualified small business stock status, you can't be just holding an option and then exercise the option the day before selling the company. That's not going to qualify for this benefit. You need to actually be holding the stock. So, Section 1202, if the stock has been held for more than 5 years at the time of the sale, it's eligible for an exclusion from federal income tax. Okay, and we're talking about an exclusion, not a deduction. I mean, it is eliminated from tax in your returns. So I am selling my company. I've got a $10 million gain on the sale. If my sale qualifies for Section 1202, then, and if I purchase the stock after September 27th, 2010, up to $10 million, I pay no federal income tax on that sale. I think this is about the biggest benefit in the Internal Revenue Code right now for small business owners. So not only would it be capital gain if it wasn't qualified small business stock, which pays tax at a lower rate, but it is completely eligible for elimination from federal income tax to the extent of $10 million if the stock has been held more than 5 years. It's a huge benefit. So why did I go all the way back at the beginning? Talk about the setting up this company as a C corporation. Well, number one, if we're going to sell it 5 years from now, 1202 becomes very valuable. Number two, why did I say, well, you probably want to incorporate earlier than later? because as soon as you incorporate, the clock starts ticking on 1202. So if you're issuing founder shares to yourself, then the clock starts ticking as soon as those shares get issued. So the sooner it happens in the process, the shorter it is to 5 years. Employees exercising stock options. Let's talk about that for a minute. If I'm an employee of the company and I came in later, I'm not one of the founders, but I come to work for this company. Why am I making the decision to exercise my stock options earlier rather than later? Well, the earlier in the process, first of all, the pricing of the stock options, which have to be issued to you at essentially the fair market value of the company, is less earlier rather than later, okay? So the financial risk I'm going to take by exercising the options is lower because I have to write less of a check for more of the company. The challenge, of course, is even though you have to write a check, and so that means that's money out of your pocket. And most people who are starting companies or early employees in companies don't have a lot of cash to be able to invest in companies, but that's something you need to consider. Also, the risk is greater earlier. I mean, the risk is you're assuming you're going to be successful, but the risk of not being successful is much greater earlier on. As time travels, if you hold those options for a couple of years, for instance, and the value goes up, the increase in the value between the time that you are given the options and the time that you exercise the options, that increase in value times the number of shares that you're exercising is potentially income to you. And so that would show up on your W-2. And just as an aside, is getting back to the company's records. That's why it's very important for the company, first of all, to be able to track those options that they're issuing, because they need to see that, first of all, you're exercising the right amount, whether you're vested or not. And if you're not vested in those, did you file what's called an 83B election, which is outside the scope of this meeting, but something you have to do? Do you have compensation that you need to record on this employee's individual tax return at the end of the year? So if you're not tracking all that and not doing your 409A calculation and not valuing it appropriately, then you're not giving the employee the right amount of compensation on their W-2, which frankly could lead to a further issue. Not only is the company subject to potential penalties and problems with the IRS, it also could lead to the same issue to the employee and could first, you're not eligible to take the R&D credit on those wages, and therefore you may not get the benefit of the $250,000. And in addition to that, you could cause a problem for your employee to in terms of getting the full benefit of the 1202 on the sale of the company. So all these things are tied together, and that's why, you know, when you come into my office and we talk about the formation and we talk about record keeping, that becomes really important. Another thing that I tell people, and this again gets back to the record keeping, this is really important for the employee side of it. If I'm sitting there with this stock and the company got sold 6 years down the road, and I'm taking 1202. How am I going to know if the company qualified, if the stock qualified as qualified small business stock? How am I going to know if the company had $50 million of assets or less? How am I going to know if I've held it for 5 years? How am I going to know if the company had, was a domestic C corporation? And if I get audited by the IRS, and the IRS does audit this because, frankly, it's a lot of money and there's real value there for them. How are you going to be able to prove it to the IRS? It's incredibly important that you get the records up front from the company to support that this is going to be qualified small business stock, and start the holding period, and document that and just put it in a file right up front. Because what happens is when the company gets sold, all the records are gone. Tracking down, I have clients that have tried to track down the CFO of the company to get some sort of a affidavit. I have clients that have gone to the acquiring company and tried to dig through records. I can tell you it's very, very difficult to get those records down the road. So I always tell my clients, when you're, in this formation stage and you're doing all this upfront documentation, get a copy, if you can, of a financial statement or a tax return for the company that supports that this company qualified as qualified small business stock as of the formation. If you can't get that, then I would go to either the CFO or the outside accountant, if you can get that through the company, and actually ask them to put something together to support that this will be qualified small business stock. So down the road, you don't need to worry about it. You just put it in a file and let it go. So that's number one, proof it met the requirements, 5-year documentation. And the 83B election is very important, because if you exercise an option that is not vested, so what happens again, and let me give you this scenario, you get issued options for the purchase of a stock that vests over 4 years. But because you're thinking that this is really going to be something, you want to exercise that option as quickly as you possibly can. Very often, a company will allow for you to exercise it early. Again, you have to write a check, and it's, if you were to leave the company, that's subject to loss because you haven't invested in the option. If that was the case, this Form 83B election, the 83B election basically has it become stock essentially at that time, rather than as it becomes vested. So it's important. I mean, it's a sort of complicated concept, but it's important that you sort of consider that if you're exercising an unvested option. And again, maintain your 5-year documentation. To summarize, again, starting at the beginning, incorporate wherever you will. Make sure that you track where your employees are. Make sure that you set up your company to do business in all the states that you're doing business. And if you're actually doing business, if you have developers that are developing something for you outside of the United States, be very, very careful. And this is, again, a legal thing, but be very, very careful that you your documentation is such that you're not developing some IP outside of the United States. That can cost you a lot down the road. But certainly in the United States, do your 409A evaluations early and do them annually. Keep good records. All of those are going to come in handy down the road when you sell a company. And that's pretty much it for my presentation. I see there's a couple things in the chat and a couple of questions, so I'll just go ahead and go to them. Yeah, so the question in terms of the 83, there was one question here that says, talks about 83B elections and exercising options. Really, the issue there has to do with whether or not the stock is restricted as of the time the option is elected. And if the stock is restricted, then it's generally appropriate to file an 83B election at that time to solidify that whether or not it's restricted, it's treated as stock at that time. Hope that answers the question. It's a little more detailed than that, but that's a simple answer.
Okay, and we have a handful of other questions that pulled into the Q&A section that happened early on. The first question was, can you share a little information about BCorps?
Yeah, a B Corp is a concept that's come into play in the last few years. And basically, they have a sort of a good corporate citizen component to them. They're recognized in a number of states. I'm not a real expert on them. They're not, from a tax perspective, B Corps operate like C Corps or regular corporation, but this may be wrong, but I always call them benevolent corporations. That sort of reminds me of the B, and the idea is that they're good corporate citizens. They follow, good social practices, and it's more of acknowledgement of how they go about business. That may not be 100% correct, and if there's an attorney online, you may be able to answer it better than I will, but that's the way I understand it. Let's see, when is it advisable to register as a foreign corporation in Delaware after being incorporated in another state? So even though we're not, so generally what happens is Delaware is the place you want to incorporate, not the other state. It's sort of, that's a backwards way to look at it, because Delaware is popular for corporations because their laws are very favorable to corporations. So corporations are sort of a legal entity on themselves. And some states allow for shareholders to have greater exposure to liability than others. Delaware is one of the states that has the least or the greatest protection to shareholders from a corporate perspective. So that becomes very popular place for corporations to form. And then what happens is, okay, I'm not in Delaware. I need to file. There's a filing form that you have to do in Delaware every year. You pay a little bit of a fee to them. It's a very simple form. And then you arrange to do business in all the states you do business. In this case, California. You go to the state of California and say, I'm a Delaware corporation, but I'm doing business in California, and arrange to do it from there. I hope that makes sense, but normally it's the other way around. If you wouldn't register in Delaware if you didn't operate in Delaware, if you had been formed in another state.
And we had another question that just came in regarding this. Is it the case that if you have IP for example, a domain name that is owned by S Corp in Delaware, you won't have to pay state tax on IP.
Well, owned by A Corp in Delaware, yeah. If IP is owned by a corporation, and you sell the IP, you're going to pay tax on the IP in the states in which you operate based upon the rules of those states. So I don't think forming a corporation in where would prevent you from being taxed on the sale of IP. I'm getting your question right. Okay. Let's see, 498, yes, they are. Well, they're not, yes, they are to do. Value restricted as pre-revenue startup. The answer is if you have restricted and preferred stock and you're a pre-revenue startup, then presumably an outside person is coming in and they're agreeing to pay whatever fair market value they're agreeing to pay. So it's not related to compensation to an employee where you need a third-party valuation. You've actually negotiated this with people that you're selling the stock to. So the need for a 409A in that situation doesn't really come into play because you negotiated this with a third party. And frankly, the IRS looks at the willing buyer and the willing seller in terms of evaluation. So that wouldn't be an issue. The issue is, of course, if you start issuing options or giving restricted stock to employees, and there's a compensation element to it, and you have these transactions that are out there, how do you come to a conclusion as to what the amount of compensation is to the employee without doing a 409A? And that's sort of a slippery slope. It's difficult to do. And the problem is that it may be easy to come to that conclusion as we sit right here. But if 2 years from now, your company is very successful, and remember, that's our premise coming in here, then the IRS has more fuel to come back and say, well, you're much farther down the road when these options were exercised. And so the compensation element is way higher than you claim. And if you have a 409A, you've got all the tools you need to fight that claim of the IRS. When would you start to pay workers' comp? Boy, that is out of my area of expertise. So I think you'd have to consult an employment attorney on that. Do the stock option records need to be notarized, CPA reviewed, CPA audited, lowest cost? I think that, first of all, if you have a stock option plan that's a qualified stock option plan, that is one that gets prepared by an attorney. So it's a formal plan that needs to meet certain requirements. And so that is how the plan comes together. If you start to issue options, they're not CPA reviewed or audited. The issuance, there may be some notary involved, but again, that's a better question for the attorney that prepares the plan. The bigger issue is when these options get exercised, should the company and me as the exercisee file an 83B election, and that's a different issue. If a company is sold, there's a question here that could you briefly tell us about what happens when a company is sold in less than 5 years of founding? Then if you're selling a C Corp stock in less than 5 years of founding, then you're going to be eligible for capital gains treatment and long-term capital gains treatment, which is a lower tax rate, but you're not eligible for section 1202, because that's definitely a 5-year holding period. Let's see.
The last question is, can I use an agreed valuation cap in a convertible note as stock value for compensation purposes?
That's a much more difficult question than I can answer here. But the bottom line is, from the compensation perspective of the IRS, you can certainly use a valuation cap in a negotiated agreement on a convertible note, but that may not serve as adequate documentation for the IRS in determining the amount of compensation in the exercise of an option, because that's negotiated for different purposes. And I would suggest that, I wouldn't use that valuation cap when it comes to supporting the compensation element of an option.
Okay, I think that's all of the questions that are in the Q&A. Thank you again, David, for this very thorough presentation.
Thank you very much.
If anyone has any questions, they can contact you. And I think we reached the end of our presentation. Oh, one more thing. Thank you to all of our partners for their support. They make these events possible. We love all 40 plus of them. And thank you all for being here today and joining us.